Good afternoon, this is James Perry at Perry Capital in Miami. It's Friday, August 15th, and the markets are closed. Once again, the U.S. stock market made another all-time high this week. Not unusual, it's happening all around the world. But generally speaking, it's mid-August. Investors and volatility are on vacation. Domestic and international government policy initiatives are the dominant investment theme. And even though they take a little while to implement, the global policy initiative trends are clear. Global geopolitical tensions are falling, and global stock markets are rising because investors do, in fact, see a safer world. Meanwhile, U.S. domestic policy initiatives dominate the news cycle, and the markets like what they hear. Global macro investment analysis is the expertise of Perry Capital. Our proprietary, data-driven, analytical asset allocation process continues to conclude the national ambition for U.S. dominance in artificial intelligence is driving an extremely powerful new industrial revolution, which should not be underestimated. It's a great time to invest. It's a risk-on market. It will continue to be so. Expect more all-time highs in Q3, Q4, and into 2026. Many of my old friends in the bond market are kind of dismayed at how bullish I am on the U.S. economy and the U.S. stock markets. After all, bond guys are skeptics. But consider the following. Central bank stimulus is driving global equity markets to all-time highs. International and domestic financial liquidity metrics, mostly money supply, all-time highs. Foreign holdings of U.S. Treasuries announced today, all-time highs. U.S. stock markets, no surprise, all-time highs, most major indices. And the reason for that is corporate sales and profits are also at all-time highs, which eclipsed the Q1 data, which was an all-time high. Household and business balance sheets are solid, all-time highs, really. Labor force, never been higher, all-time highs. Wages have never been higher in a generation, all-time highs. Home prices, all-time highs. Automobile prices, all-time highs. And even rents in places like Miami, Chicago, Denver, New York, even New Orleans, believe it or not, all-time highs. So it's no surprise to see GDP, which is also at an all-time high. The country has really never been more prosperous. And it's also abundantly clear that U.S. debt has never been higher either. The U.S. economy is being transformed before our very eyes. Public and private investment is being directed aggressively towards the global dominance in AI. Consider the following. In 2024, total private investment in AI was $1.7 trillion. This is from one of the Mag 7 major hyperscalers. That's about 5% of GDP. In 2029, that percentage of GDP is expected to be 25%. Spending, 25% of GDP. Partially because government support of the AI build out, because it's a race that the government wants to win as well. So you got the private sector aggressively spending, government supporting it. What's that mean? It means the U.S. economy is becoming much more productive. Money is being redirected toward industrialization, the reindustrialization of the United States, in every category. Incentives for investment, depreciation, lower taxes, deregulation, you name it. And that's very good because a lot of the investment that we've made, especially through the pandemic period, was really not very efficient. I'll just be polite and say it that way. The cost of production is also going down. This is very much a robotics story. It's a very much a data story, and prices are falling. The bond market sees this trend. It recognizes that the cost of production is going down and corporate profitability is going up. You can see that in the numbers in the Q2 earnings reports. Risk premium is falling as well. Credit spreads across every major asset class is today, at the close this week, at a record low. Furthermore, forward pricing for inflation protection in the markets is falling. The market recognizes this is not inflationary. Tariffs are not going to have an inflationary stagnation result. It will be deflationary and pro-growth. Domestic manufacturing is resurging, and so is confidence. Expect more in the quarters ahead. We can't end this weekly video without talking about the Fed. After all, the Jackson Hole Symposium starts next week on the 21st through the 23rd, and the Fed meeting about rate changes will be on September 17th. My view is the Fed should not cut rates. More stimulus will stoke more inflation, and the inflation we have will remain stickier, closer to 3% than the Fed's target of 2%. Retail inflation is running at 2.7%. Wholesale inflation is running at 3.3%. That's a little bit of a tick up. Why? Service inflation is rising. Goods inflation is not, as expected. Tariffs are not causing inflation. They've been yelling about it for 6 months. It's just not the case. Service inflation is caused by the amount of deficit spending and horrific government policies that have been in place over the last 4 years. Electricity, for example, is up over 2% this summer. Electricity is not important. I think additionally, companies are using the excuse of tariffs to pad profit margins. We can see that in the corporate earnings that we've gotten so far in Q2 here. Revenues and earnings are at record levels. Liquidity is ample. Money supply is as large as GDP, and global money supply is even higher. higher, larger than global GDP. But credit spreads do not evaporate. And if you stimulate more and reduce interbank lending, you'll get more people who probably shouldn't be getting loans. This is why the prime rate still is at 7.5%, and the broker lending rate is at 6.25%. So I think the Fed's political. Maybe they do it anyway. I can't say how they're going to decide. But as far as the data is running and the data is concerned, I think a Fed cut in September would be a mistake. So what do you do here with all this information in these videos? Very simple. I believe that stocks will make new highs. Why? It's simple. Investors see what's going on. Inflows into the equity markets are at all-time highs, both domestically and internationally. Equity prices are rising because equity earnings and revenues are rising powerfully, led by tech. The dollar is stable and trending higher. Rates are stable and trending lower. Monetary policy remains highly stimulative, unlike sometimes what you hear from certain government officials. Fiscal policy remains highly stimulative. Federal tax policy remains highly stimulative. Federal regulatory policy remains highly stimulative. And again, liquidity is ample. The Chicago Fed does a national financial conditions index. That index is measured in a negative number. It's minus 0.53%. That is the lowest number, the most liquid financial conditions as measured by the Chicago Fed since July of 2022. So the Fed truly does not need to cut the Fed funds rate. They may on September 17th, but there's a lot of data dependency coming between now and then, plus the Jackson Hole meeting. So my bet is no cut. Have a good week. I'm out next week in New York on a business trip. Thanks very much. If we can help you in any way, don't hesitate to contact us. We'd be delighted to speak with you. All the best. Have a good weekend.